Good afternoon. This Tuesday, July 22nd. The grain trade seeing strength in the wheat market as the Russian wheat farmers are kind of holding back supply, getting end users a little short bought, a little pinch in there. I don't know if it's lasting or enduring at this time, but it is interesting that our wheat harvest is now well over 70%. We're probably, as of today, 75% harvested, 72% as of Sunday. That means our hedging pressure is falling behind us, and the end users don't have that fortune of getting the grain that's dumped at the elevator and forced sailed. Now there's a little more subjective, and some of the grain is actually being stored away. So once grain gets behind a bin door, you got to kind of bid it out. So the reality is seasonality of wheat bottoming could be behind us, and we'll get to that in the charts here in a little bit. Meanwhile, the corn market softening again today. What is it? Third week in a row, 74% good to excellent ratings. They're using 2016 and 2018, I think, for crop anomalies. Remember, crop condition score is a green score. It's not a perfect measurement of yield. It's one of many various factors that can be used in it. But right now, everybody's running roughshod with it. And oh my God, we have 185 to 191 bushel to acre corn. But of course, you are aware of the pollination concerns that are sprouting up across the country, especially in the east. Whether that does come home to roost and become a problem, we won't see that, I think, until the October crop report. Maybe a little bit in the September one, but October is really strong yields across the country. So let's take a look at the charts, see what's happening. On the daily continuation corn chart, after a brief rally, again, the gaps always prove formidable. Find it interesting, the 78% retracement for the month of July. The spot corn September has been pinballing around it. It actually fell below it, bounced back above it. We were holding earlier. Keep in mind, December will come on this chart in about 2 more weeks. And so September corn probably breaking lower, making another new low yet here. Wave 2 style, the prior lows were in the 360 range, so I am looking for on the monthly charts, continuation charts, that just possibly, yes, last year's lows is a stair-step low. We've been stair-stepping inflation here over the long haul. Granted, inflation in grains is also measured in revenue, so bushels always increasing. That's why these prices can come slamming down, and during this whole window here through 2015 through 2020, stagnant prices. Yields, of course, were reasonable through most of the part there. The reality check of the dollar was strong, hurting our exports, but still, we had a rising value that still could be found. So now whether last year's low is synonymous with this, or we have to come crashing down into this price level here of the 350 range, that'll be if we do in fact have a corn yield of 185 to 191. Well, that times a number gives you revenue, and there is your inflation in acreage and production. And so, but I'm kind of on the step that we at least are seeing something here stair-stepping higher. Whether this low is in yet or not, that's to be debated. On the December corn chart, pushing back lower. We over the weekend said if you are not 50% sold as we are from these values, plus we're insured, you better get something on Monday morning. Well, that would have put you in here about $4.25 because obviously we can bleed lower. Was this outside day upturn on July 14th a low? Well, it was a significant low, obviously, but whether it's the low, there's an old saying that, well, we never make highs in February. Well, of course, we know that is not true here anymore. Well, we never make lows in July. So we'll see which one works out. My perception is that we are likely going to see this market try to grind lower yet. Typically, we get a low in August for the corn market. So we'll see if maybe the $4 level is attempted again here into early August for corn to make a low. On the wheat chart, interesting action today. Really want to talk about this. Outside day up on wheat today. Now let's go into the December wheat chart. Last week, I said, well, we can throw away the head and shoulders bottom because here we were always holding on a closing basis until that day. And wheat is notorious for this garbage. When it bottoms, it'll just bottom, well, necessarily a spike low, but sometimes it'll just close pathetic and then just start moving the next day. Well, that was certainly a pathetic close, massive gaining day last Friday, a minor 1.5 day correction, and we get an outside day up. That's very friendly. Of course, one could say, yeah, well, we've seen them fail before. Yeah, here's an outside day up that failed. But then again, we've had other outside days up like this one that worked quite well and continued higher. And so, it is a technical factor. And what it implies is even if we soften at the end of the month, It just means that this day's low, of course, lining up with all these lows here, implies something's important. So I can venture to say that the 555 to 560 range for December wheat, very important support. And if they want to retreat there, probably a buy in that zone again. Even Kansas City wheat caught in the action, outside day up, stopping right at moving average resistance. Of course, we've seen what happened here before, a 2-day bolt through moving average resistance when we changed contracts, and they gave it up back in June. So outside the up is also prevalent here on this market here, moved higher, and so we'll see if we can get a signal off of this. Again, it can pull all the way back to the lower level of the outside day. As long as it doesn't close below it, it's a signal that something is changing here. Well, harvest 75% done. You know, the harvest pressure is leaving us. Spring wheat, different animal. Crop is green in the north, getting a lot of rain up there. Maybe the spreads will narrow between winter wheat and spring wheat in the near term. French milling wheat, even here too, up against resistance. Of course, operandus modem would be they're going to sell the hell out of it somehow, some way, which implies we will get a correction here on the wheat trade from today's beautiful bounce. But still, something is building in here, and French milling wheat bottomed in June, whereas we also bottomed in May and then have held so far and been slowly working sideways to higher. Soybeans, well, we had a wave 1 high last week. We had discussed, we had the ABC decline, wave 2, which could have bottomed as high as 997 to as low as 993. Actual low was 998 and a quarter. Pop tire, wave 1, resistance on the downtrend line, and now we are in wave 2. Wave 2s could get us back to about that 1014, 1015 support zone, which lines up with 618. But wave 2s just love to do 786s. So I'm going to venture to guess 1006 to 1008, probably the objective of this wave 2 before we get a turn up, probably after August 4th. Seasonally, we typically bleed between now and August 4th and then probably turn back higher again. Now, if they really want to destroy this market, we can go all the way back down to this trend line support, which then I can move this 2 down to here. And we had this zoomed out before. This is down at the 980 range, but we'll see what develops. August weather is an unknown. They're looking into the opening days of August. They think everything's okay, but then again, we've thought that years before. We get into August, we burn everything up into the end of the month of August and early September. So we'll see. The wave structure allows for something to come. Maybe it's a trade deal. Maybe it's China shocking the world and buying a few beans from the U.S. again, and not as an unknown, but as reportable. Cattle, new contract high again today as the August live cattle we think is trying to trend its way higher on our weekly chart measurement. This is, of course, October is now on the chart as of the last 3 days, but the measured move theory on our weekly chart, if we take wave 1 and make it equal on wave 4, we measure up to 234.5. So we'll see. It's a guideline that says we can go there. If the cash trade does not want to buckle, and if the Texas cattle want to work in the 230 range and hold until the end of August, well, we're going there. On the feeder cattle chart, another new contract high. We've said this before. We highlighted these in red last week. If wave 1 and 5 are equal, we go to 330. Today's high, 329.57. Okay, but if we do the golden ratio, and in bull markets, they love to do 1618s, 1618 of this takes us to 337. And that could give us a 5 of 5 of 5 of 5, 4 5s in there. A culmination of some kind of peak here to the upside. And that's what we show on the cattle for now. The oil market, I think even though we've kind of violated the purple line here, we're still kind of holding the low made in June. I think we've got a wave 2 recovery bounce in here. Everything's a 1-2, 1-2. The reality check that this was an A, possible B wave low, and now we're going to get a C wave rally, at least equal to the length of wave A. That implies we'll take a run at the 50% mark, somewhere at 71, maybe even the 62% retracement, just over 72 to give us a wave 2, a final ABC, and then of course we're on record, wave 3, a big 3, heading back down in at least the low 50 range, $50 range. That probably occurs later on in November, December, after we get through. This is probably tied to our hurricane season in August, September, and then we come off. This is Eugene Grainer with Heartland Investor Capital Management. I hope you find this information useful.